strong numbers expected, but of course we have
Thank
to
you for having me.
bear in mind the base effect, right?
Yes, absolutely. So the numbers look fantastic. So if you look at the year-on-year numbers, the growth are very high. First quarter, 18.3%. And in terms of real GDP growth, second quarter will still be as high as, in our view, 7.2%. So actually the numbers look good. And inflation looks low, so almost like a Goldilocks situation. So from a policy maker's perspective, 2021 is a nice year that they don't have to worry too much about short-term inflation or growth, downside or upside. So actually that they are now having, in our view, a window of opportunity to do something that they probably wanted to do for some time on the structural long-term side.
You talk about inflation. I mean, there is a divergence there. Prices linked to commodities are high. Prices linked to households, not so, looking pretty stable. How do you read that?
Well, first of all, I would say that the PPI inflation is high, mainly driven by the commodity prices, as they have surged quite significantly, especially in year-on-year terms. And at the same time, I would say that, however, there is very limited evidence that such inflationary pressure has been passed on from the upstream to midstream to downstream within PPI, not to mention to even further downstream to CPI inflation. So at the moment, this reflects that from the supply side, there is probably more pressure that pushes that cost up for commodities. But these manufacturers are probably unable to pass it on to demand side because the final demand is not strong enough.
So, Helen, how does that translate into the trade data that we're expecting, given that perhaps export numbers are firm, but we've got a lot more to go with the import numbers, don't we?
Yes, absolutely. So what China is seeing is that China is importing about 1/3 of its imports from commodities. And because of the jump in commodity prices, this basically implies that China would have a deteriorating terms of trade because they have to pay more for higher priced commodities, while at the same time, they may not be able to price that completely onwards and pass it on to the downstream consumers. And therefore, the import price increases will be more notable than export price increases. And therefore, China could potentially get a loss there.
Would that, in some way or the other, have a so-called crowding out effect?
Well, not necessarily that immediately this would actually hurt the companies, because depending on where we go from here, if we are actually seeing that the final demand is getting stronger, and we will see that these manufacturers would be able to pass on such cost increase to the final consumers, and then CPI inflation will go up, right? But if actually aggregate demand becomes relatively weak, and therefore that probably means the margin squeeze would actually be quite painful for these companies. But at the moment, I think that we're probably going to see neither nor. We're probably going to see actually the cost push coming down a little, especially when the base effect from last year normalizes.
Helen, where does growth go from here for China? We had Fred Newman from HSBC saying that, you know what, don't be too carried away about the growth prospects in China.
Well, I think that actually investors are not necessarily too interested in growth stories on China anymore, given that China was, when it comes down to the COVID shock, when last year it was first in, first out. It was the first one to recover so quickly, and therefore people largely think that this is already no new news, right? We already know that China has rebounded. But I think this year there's still something quite important to watch, which is the remaining piece of jigsaw puzzle, that whether it actually comes down there in terms of service sector normalization. And in the past weekend, the Labor Day long weekend, we have seen that actually there's a very notable jump in terms of transportation, accommodation, movie box office, and overall domestic tourist numbers, etc. So that's actually good to see. But this definitely takes time, as the Central Politburo meeting pointed out last Friday. And therefore, policymakers are still keeping the relatively accommodative policy stance in place.
Well, that's exactly what I was going to talk about, because they've got to do it slowly. They're going to have their own taper, haven't they? Take the punch bowl away slowly, as it were. How do they do that, and what are the inherent risks?
Yeah, that's the tricky question, Rich. I think the issue is that the market is already very worried that they are going to start to tighten right now. But we actually are not seeing too much of the actions yet. We're seeing the PBOC maybe conducting a little bit of window guidance, telling the commercial banks that maybe you should, be more differentiated in terms of the pricing strategy on loans when it comes down to, which sector should actually get it cheaper while others should get it more expensive. But we haven't seen a very tight grip on overall credit expansion pace. And we think that's probably not going to come until second half, after July 1st, after the celebration of the 100th year anniversary of the CCP establishment. We will, however, probably see a higher chance of the next Central Politburo meeting, which is expected to be held at the end of July, to gradually tilt this policy position towards modest tightening. And by then, we will probably see more, notable or officialized kind of stance coming in, especially when it comes down to guidance to slow down some lending.
Helen, before we let you go, what's the outlook for the yuan? Is the commodities rally a headwind for the currency, given that there'll be more demand for USD?
Well, the pressure on China is that indeed China is seeing the terms of trade deterioration and paying more from on its imports. In theory, this would reduce the current account surplus, and therefore China will probably see less pressure for currency to appreciate. But our FX strategists are of the view that the USD CNY rates would probably still gradually shift towards renminbi appreciation to 6.30 at the end of this year. And we keep the same level of forecast for 2022 at the end of the year at the 630 as well. So I think that also largely depends on not only the commodity picture, but also the rate differential, the interest rate gap between US dollar and the Chinese yuan. At the moment, it actually has widened a little bit from the previous month or two, but over time that still depends on whether the PBOC is going to tighten, and this could potentially give rise to further expectation of renminbi appreciation.